gives me great pleasure to introduce Carmen Nuzzo, who is Head of Fixed Income at the PRI. She has kindly stepped in to moderate this session, and we're very excited to have such an expert with us today. And Carmen, it would be great if you could just introduce the PRI briefly, and then I'll leave the rest of the session in your capable hands.
Thank you, Caroline. Thank you very much for the invitation, and I'm delighted to be with you today. For those of you who are not familiar with the Principles for Responsible Investment, or PRI, we are the largest investor global association promoting responsible investment practices across all the value chain. When the PRI was launched back in 2006, we only counted with 100 members, and most of them were focusing only on equity investing. But today we're about to celebrate exceeding 4,000 signatories that collectively manage more than 100 trillions in dollar terms. And there's been not only a growth in the number of signatories, but also in the breadth of the asset classes in which they invest. Once the sole purview of equity investors, as I said earlier, now our signatory base invests in real estate, in infrastructure, and more recently also in fixed income investor in the fixed income area where I work. Within fixed income, we look at corporate debt, but also sovereign debt, sub-sovereign debt, private debt, and securitized products. So you can really appreciate how quickly the interest for responsible investment practices is spreading. I would say calling this mainstream investing is probably too far, but it's definitely no longer a niche type of thinking. What I also witnessed in my years at the PRI, it's also a change in the purpose for incorporating environmental, social, and governance consideration in investment decision. So investors are increasingly shifting away from pure risk assessment, and they're encouraged to think, or perhaps even explain now by the regulators, how their investment decisions are contributing to the real world and to the economy, and how they can drive sustainability outcomes, which could be either positive, but also contributing to the reduction of negative ones. Just specifically on fixed income, I wanted to say a couple of words regarding an initiative that I've been running since 2017, which has been extremely successful in connecting credit analysts with credit rating agencies and borrowers and issuers. It's called the ESG in Credit Risk and Ratings Initiative. I work with over 171 investors that collectively manage more than $36 trillion and 26 credit rating agencies, including the large global players such as Moody's Investor Service, S&P Global Ratings, or Fitch Ratings, but also smaller credit rating agencies that are specialized either by country and by product. And as part of this program, we've been organizing roundtables, initially only for credit analysts on the investor side and the credit rating agency side. We've organized altogether between 2017 and 2019, 22 roundtables in different 15 countries. And as of last year, we're now bringing to the table also the corporate borrowers. The reason why I wanted to talk to you about this is because in these roundtables, we discuss a variety of topics. Disclosure is at the forefront of people's mind. Of course, the materiality, the financial materiality, I should say, of ESG factors to credit risk, the issue of what are the credit relevant time horizons that one needs to think about, but also how to improve communication and transparency. But during this conversation, what has become very clear is also that we need to equip the credit analysts and the risk managers in general with the right skills and the right resources, some of which, for example, when it comes to climate change, as Anne-Marie was saying, require science-based targets and very specific knowledge. And so these conversations have really been instrumental to create an environment of mutual education, I would say. At the company level, for example, we reached out to CFOs and treasurers, some of whom were actually reluctant to come because they thought that these questions were more for the investor relations department or the HR department or perhaps the sustainability departments where they exist. But actually, they enjoyed the discussion because they had a chance to communicate their strategies directly to investors, to convey their priorities, and perhaps even share their frustration at times due to the amount of information that they now have to disclose, not just to investors, but also to the regulators or to their clients, depending on where they are in the supply chain, for example. And also, it was a way to educate investors to ask pertinent questions, and for credit rating agencies to explain to their clients why now they're asking more questions related to ESG topics, as well as the organizational changes that at least the large global players have been undergoing in recent years, partly thanks to this initiative. They all now have sustainable finance departments that work very closely with the credit analysts to enhance the transparency of ESG factors in their analysis. So to conclude very quickly, although the discussion around data disclosure and materiality is still very topical at the moment, what came out of all these roundtables is that it really, beyond a data set, which is important to profile issuers, but can provide a backward-looking picture of an issuer, the engagement and the communication and the mutual education are extremely important as we move towards a more forward-looking type of analysis that focuses on trajectories and strategies. And so to speak about all this, I'm very lucky to have with us a very esteemed panel that I will introduce in alphabetical order. You've already heard from Caroline Stockman, who's the Chief Executive of the Association of Corporate Treasurers. She will be joined by Louise Prior, who is President of the Institute of Actuaries. And last but not least, Andrew Harding, who's Chief Executive of the Chartered Institute of Management Accountants. So welcome to you all, and thanks for taking part in this panel. So I gave my 2 cents experience from the investor side of what I witnessed in the last few years. Perhaps you could tell us a little bit about yourself and your role in your organization, and also I'd like to hear from you. What do you think is the most important current issue when it comes to equipping analysts with the right skills to incorporate ESG consideration in their practices? Caroline, perhaps we can start with you.
Thanks very much, Carmen, and thanks for that introduction. Yes, so from the ACT's point of view, so we're the Association of Corporate Treasurers. Our members are treasurers in corporates, surprisingly, not surprisingly. And I think things have evolved quite rapidly recently. We at the ACT have been passionate about raising the issues around sustainable finance, green finance, etc., and more broadly ESG over the last years. And we found at first quite a slow uptake. I think there were lots of fears about greenwashing and people not necessarily comfortable and also thinking, gosh, what's coming at me now? Is this really key to what I'm doing? But we've seen very rapidly, and I think through COVID, it's accelerated, that people are much more engaged. There's a lot more activity in terms of, for instance, issuing green bonds, etc., and much more holistic programs, shall we say, that are often driven by the Treasury team in certain aspects. But I think right now the issue and the fear, if you like, is around the upcoming regulatory and reporting requirements. People have seen this before in other areas where they have a huge list of stakeholders, our Treasury community, and classically those stakeholders will all ask for something slightly different. So, in terms of stakeholders, there's the shareholders, of course, there's fixed income investors, of course, there's the rating agencies. And for our members, it might be useful to have a look at, if you haven't already, some of the content from our conference the other week, the annual conference and International Treasury Week, because we had sessions there with S&P, Global Ratings and Fitch, and if you dip into those, if you haven't already, and hear what they're saying, I think it's quite important to be up to speed with that. The lending and other relationship banks, as well as key suppliers and customers, they are all invested in this, and they all potentially will want something different, which will, in effect, give a lack of consistency, but also more work. And Treasury teams are small teams. If we look at our multinational Treasury teams, if you take out the really, really big guys, they have on average 2 treasurers, a department of 2, and then when they're facing all kinds of different regulatory requirements, something coming on top of that is going to be difficult for them unless people can coordinate and we can have something that's comprehensive, and you do it once and that's it. And I think there's a fear that the UK may develop a different taxonomy from that of the EU, which then gives complications, of course. So I think those are the major issues for them. And I think, but I do think they're on board, and I think it's very interesting, this conversation, I think, was started a couple of years ago in the US about shareholder versus stakeholder. And more companies and their boards are understanding it's not the bottom line, it's not the shareholder that has primacy, if you like. It's actually a whole range of stakeholders. And it's really important that your employees, society around you, everything else, all those different stakeholders like you as a business. Otherwise, you're not going to be successful. So I think the Treasurer's definitely on board with that, and it's now down to those practicalities.
Yeah, thank you, Karen. I think what you said resonates very much with the experience that we see on the investor side. You mentioned the slow uptake initially, the fear for the regulatory changes, which is very much top of mind of our investor base as well, but also the lack of resources the companies face, including in the treasurer's department, which is very important and needs to be addressed. Louise, perhaps I can turn to you now, and if you would like to share with us your experience and also your topic in terms of what's your main worry at the moment, or you see as the main challenge.
Thank you, Carmen. So I'm Louise Pryor. I'm the president of the Institution Faculty of Actuaries. Actuaries work mainly in pensions and insurance, but also broadly spread across the financial services and other sectors. We have actuaries, a lot of them working in the investment area now, some in banking, and all sorts of other nooks and crannies, as one might say. And our main focus is on risk management. That's the sort of focus of our profession. And in this case, what it means is that we're very aware of the need to consider a full range of outcomes, including low probability outcomes. So, for example, the Paris Agreement sets out what we need to do, or sets out an aim of keeping substantially below 2 degrees, talks about net zero by 2050 and so on. That's fantastic, but the pathways that are described give us a reasonable probability of achieving the target. It's not definite, and we need to be aware of the full range of possibilities, both good, better than expected, but also, I think, specifically worse than expected. And that's something that we're very keen, obviously, that our members are aware of, and that's the way actuaries think. But I think it's important that other people, especially in the green finance community, recognise that too. So just doing, for example, net zero by 2050 is no guarantee that the overall aim is going to be achieved. It is basically a risk management problem, a risk management problem for society as a whole, but also for the individual organisations that our members and all the members of the bodies, associations represented today work in. Another issue that we're starting to try to get to grips with, which is, a difficult one, is one thing about climate change is it's fairly easy to measure. We have this temperature metric that's fairly easy to get a grip on, but biodiversity loss and the impact of deforestation, both of which are amplified by, and in their own turns amplify, climate change impacts. It's all a big complex system. We have no good metrics for those. And that's something that we think is important and needs to be considered. So that's it, really. I think if you just remember risk management and can't assume that the best or even the most likely is going to happen, that would be my takeaway.
Thank you, Louise. And this is actually music to my ears, because I work with fixed income investors and they're constantly worried about downside risks. And so I think what you said about creating a mentality of really thinking about probabilities and scenarios is very, very important, because, as I said earlier in my introductory remarks, we are facing a very uncertain future, and we need to make informed statistical probabilities. And so stress testing or the scenario analysis that are at the very core, for example, of the task force for climate related disclosure recommendations is very pertinent. I'll come back in a minute to your point about biodiversity, because I think it's very important. There is very much focus on climate change and climate measurement, but biodiversity is coming up on our investor agenda very quickly as well. I'd like to turn now to Andrew. Perhaps you can share with us your main or your challenge and tell us a bit more about your role. You're on mute, Andrew. You're on mute.
I swore I would not do that this morning.
No, don't worry. There's always somebody who does that, and you won the prize today.
Carmen, thank you very much. I was actually SEMA's last chief executive. In 2017, we brought SEMA together with the American Institute of CPAs to operate as one organisation. I currently lead all management accounting activity for that organisation. You will see us called AICPA and SEMA. You'll also often see it referred to just as SEMA within the United Kingdom. SEMA was created in 1919. It was created by a number of sponsoring industrialists. Primary amongst those was Unilever, and very much to solve a problem around businesses or finance looking forward, and finances supporting decision making in businesses and helping the leadership of Unilever really work out how their businesses were performing on a day-to-day basis and what they should be doing to look good in the future and do well in the future. We stay with those values to this day. Management accounting is all about supporting business decision making. When I listening to Caroline, she was talking about multiple stakeholders, and I think it's really interesting. If we look backwards, up until the early 1980s, financial value was a pretty good surrogate for business value. That's now fallen away. A company's balance sheet probably represents about 20% of its value. So the financial capital of a business isn't reflected in its value anymore. The other thing that changed in the early 80s was a shift in terms of multi-stakeholder views from business leaders to this idea of shareholder primacy, very much driven by Milton Friedman in the Chicago School. And that's been in place for 40 odd years. We're starting to see that shift very, very quickly. Ironically, probably one of the leading businesses in that is Unilever, which sort of brings the SEMA story full circle. For me, the big challenge is to have businesses measuring all aspects of what they do. Their management accountants have always looked at efficiency of production for manufacturers. They've looked at wastage. They've looked at all sorts of other measures to give indication of things which need attention. It's not always been about the money. These systems exist in businesses to do this measurement. We're seeing a great move at the moment around corporate reporting. The risk of that is that if the report is produced in isolation at the end of the day, it risks greenwashing. For me, the biggest issue is to ensure that all of this thinking, all of this work is integrated into the decision making of the business, not only on a day-to-day level, but also when it's doing its long-term strategic and operational planning. We need to be seeing all aspects of business's activity, all uses it makes of materials, be they financial assets, be they natural assets. We need to see all of that reflected, not only in its annual report, but in its day-to-day work. We call that integrated thinking. Getting that embedded is what we need to see. We have 700,000 professionals we represent across the world. That's a pretty good number for us to start influencing and driving that change. And as I say, they've been measuring this sort of stuff for a long time.
Thank you, Andrea. Actually, I like the term integrated thinking, because we talk on the investor side about ESG integration when it comes to full embedding these considerations in investment decisions. And through the conversations that we've been having, it's really what has emerged is that some of these ESG factors have always been traditionally considered in the analysis, but perhaps they haven't been labeled ESG in the past. And so we've really been doing an exercise of extrapolation and being more explicit about what's old, but also start to think about what is new. Going back to your point about long-term planning and long-term thinking, which is very important as well. I'd like to turn back quickly to Louise and pick on her point about biodiversity, which I think is very important, because the recent GovTech review focused on the economics of biodiversity and calls for changes in how we think, act, and measure economic success to protect and enhance our prosperity and the natural world. So, Louise, what did you take from the review, and what do you say in particular is the role of educationalists?
Thank you, Carmen. What do I take from the review? I think it's a really important review. I think that it's not before time, and it's great to see it out there. What it does for me is really emphasizes the importance of the long term. And of course, actuaries have been looking at, long-term risks is what actuaries do. So obviously I'd like that aspect, but also the importance of taking a systems view to this. You can't look at biodiversity in isolation. As I said before, it interacts with climate change, it interacts with all sorts of other sort of environmental factors, but also economic and financial factors. And we can't look at either the environment or the finance world or the economics world in isolation. They are all interconnected. And as educationalists, what we have to do is we have to help people understand those interconnections and develop methods for dealing with them, and develop our understanding, for example, of the most appropriate use and structure of natural capital accounting, which is a very active field, obviously, and is making good progress. And I think our view at the IFOA we see as one of raising awareness among our members, among actuaries, about the urgent need to take these risks into account. Just because we don't know how to measure a risk yet or how to deal with it doesn't mean that we can ignore it. It's really important that we face up to this challenge.
Absolutely, I cannot agree more with that, and really I'd like to stress the need for the long-term view, which is very much missing, particularly among financial markets that I work very closely with right now. So perhaps, Andrew, do you want to add anything to this point, or and then I'd like to hear Caroline's views as well from the Treasurer's perspective.
Let me see if I can add a bit of colour to it. Some of these things have been thought about by academics and theoreticians for many years. They've been dismissed by business as too difficult, therefore we'll ignore it. And in particular, when you come to accounting for natural capital, that's probably the big one up there. They used to call it externalities, external costs, forget them. Government might correct it with taxation, but apart from that, we won't care. A typical sort of example. If you look at the extraction industry, they report costs of extraction. They don't record any cost of replacing what they've extracted. So they're not. We're not seeing the true cost. We're not seeing the true cost of that activity reflected, and that's probably the most stark, easiest to grasp example of this. In terms of how we educate, I'll look particularly at how we educate financial professionals. We're building in these measurement systems into our programs, both for those who qualified recently, those who qualified years ago, and those who are starting their careers today. You know, it's all very well us building it into degree programs, us building it into our professional qualification programs, but alongside that, we need to recognise that there are a huge number of people out there working who haven't had that built into their education and learning, and we have an awful lot of catching up to do. We understand biodiversity. We talk about biodiversity. We focus on the Amazon, and we focus on Borneo and other rainforests. What we ignore is places like Dartmoor. Historically, we're actually a rainforest area of the world, which was deforested hundreds of years ago. So there's a lot for us to think about. And as you say, it's long-term thinking.
Yeah, and of course now the population is a lot bigger than when that deforestation process started. And I'm a macroeconomist by training, so we've always made macroeconomic forecasts, taking natural capital as a given and not really thinking about the rate of depletion of natural capital, which is something that we should start doing more in the future. Caroline, from the Treasurer's point of view, what's your take?
I agree with a lot of what's been said, but particularly from Andrew there, maybe our treasurers are a bit, we probably go in order from Louise to Andrew to myself in terms of removed from the concept of economics of biodiversity and natural capital. I would suggest, because I don't think it's something that our treasurers are that au fait with, though things are rapidly changing. And I'd also like to add, on a general level, humans, we were very close to nature, and it all changed after the Industrial Revolution, and a lot of us live in cities and we're quite far away from biodiversity. And it's been interesting through COVID, as people have reflected, they've got a little bit more back to nature in many places. And apparently the studies show that our well-being and our resilience is very much enhanced by being close to nature. So I think at the same time as the acceleration of us understanding that we need to do more to protect our planet, there's also that more emotional attachment that is developing through things like COVID, where in certain parts of the world, suddenly there were no cars on the streets and it all became very different. People noticed birdsong, etc. So I think that's a really interesting kind of element to this whole shift, if you like. I think for treasurers as well, it's going to be really important. The reporting and thinking how you do that is, of course, important for many people in finance in a business. But for the treasurers, I think we'll be looking at the methodologies they use. So not only reporting, but how do you actually evaluate things? So we will use things like weighted average cost of capital or the capital asset pricing model. Those need to be rethought in the light of natural capital and other things that will be then later reporting on. So I think shifting it to think, how do we actually integrate this way of thinking into our decision-making process and what we do, rather than the historic reporting. I think that's going to be very important. And in terms of education then, very briefly, the ACT, we do talk about green finance at various levels in our different qualifications, but we need now to do a lot more as things are accelerating. And that's through a variety of means, through our actual qualifications themselves. As I say, there's quite a lot in there, but lots more to go. But then also the surrounding ways that we educate through CPD, etc. It's so fast moving, we're going to need to be a little step ahead so that we can help lead our treasurers through this.
Great, thank you, Carol. I'm glad you mentioned COVID, because that's been really key in elevating the discussion on not just social factors but also environmental factors, and the need for further education. Obviously, is there more than the education as such, is rethinking perhaps also old ways of calculating or taking measurement, and very much like what Louise said earlier, that even if we don't understand the risk, it doesn't mean that we shouldn't take that into consideration. So we have to be aware of perfect not being the enemy of good. I'd like to turn now a bit perspective into the future. And before I do that, I'd like to remind the audience that if you want, you can start asking questions, which we'll address in a few minutes. So perhaps I'll start again and use the chat function to do that, please. Let's start again from Louise. So what do you see in terms of future developments going forward?
I think what we're seeing is a huge growth on the regulation and reporting side. So reporting against TCFD recommendations, for example, is becoming much more widespread and in some areas pretty much mandatory. And certainly the reporting by insurers overall has improved enormously. They're making huge steps, but there's also a big range. So some of the large insurers are doing very sophisticated and effective reporting, whereas some of the smaller ones are haven't moved as far up the learning curve. But we've got to remember that reporting is just a tool. What really matters is action. And I would like to see the financial services sector, in particular banks and insurers, think about how the services and products they offer actually support a transition to net zero. And also help consumers navigate the changing risk landscape. I mean, I think we have seen with COVID how risks that we never dreamt of turned out to be much sort of bigger and more systemic than we imagined. And I think we need to help society address those risks. And that's one of the things that the financial system should be doing. At a global level, what we're seeing is that some actuaries in some countries, and I suspect this is very true of other financial professionals too, aren't yet too sure of the importance of climate risk in particular, but other sustainability risks. I think it's being driven very much by regulation. So here in the UK, in Europe, the regulators are really on us, as it were, and telling us a lot of things we should be doing. But in other countries, it hasn't got that far ahead. So I do think that regulation is a vital tool here. So it'll be interesting to see how that spreads.
Yeah, and this country, the UK, is definitely at the forefront with the initiatives that were spearheaded by the Bank of England in terms of regulation. But I agree that there is need for a more effective, perhaps, coordination of the different regulatory requirements globally, because we're seeing efforts in Europe, we're seeing efforts also now in China or Canada, and as Caroline said at the beginning of the panel, the risk of there are challenges related to this dispersion of efforts when it comes to the actual implementation of these decisions for the real actors who have to put the hands on the problems. Perhaps, Andrew, would you like to share your thoughts in terms of what you see as the main challenge for the future?
Yeah, I'd love to share my thoughts. I think we can start with looking at what's going on at the moment. At the moment, there are 200 plus organizations competing for share of voice in what should be done, how reporting should work, and how we should be moving forward. That's a crazy situation. We need one model. We need a global model. This isn't an individual national problem we're trying to deal with. It's a global problem. It's not a problem where we can cope with having 200 different competing models arguing about which is the best. You know, I like TCFD today. I think it's very stark. It shows pretty quickly what the problem is. You know, one CFO said to me, 1 degree of climate change puts 60% of our manufacturing underwater. 2 degrees said it's not even worth thinking about because we're finished. Really sharpened his thinking. So I think bringing it down to one model is great. The combination of the American SASB and the British-based Integrated Reporting Council last month is a big step forward. Two of the biggest of those operators coming together as one. So that rationalisation is going to be critical. I kind of raised my eyebrows a little bit when Louise talked about the UK being a leading organisation in this. I put the UK as a middling organisation. I don't think we are leading. I don't, and certainly the Americans aren't leading. The Americans are definitely lagging behind even where UK is. I think we have a danger of what is currently 200 competing intellectual-based organizations becoming geographical-based competition, the Americans wanting to invent something of their own, the European Union desperate to invent something of its own, and a risk for those of us in Britain sticking our noses in the air saying the Brits know best, which is something we have a bad habit of doing. If you want to see real leadership in this area, you're going to have to start looking at places like South Africa. Places who've actually gone ahead, taking these bold decisions and taking them earlier than anyone else. You're not seeing leadership from the traditional leading Western centres of influence, and we need to open our eyes to that. I think if we start to think we can benchmark by where UK is today, we're going to be moving backwards. There are better people to look at for examples. That doesn't mean we can't make a positive contribution. I certainly believe we can. We've got some of the best resources, some of the best thinkers in the world. But we need to recognise that we've got a way to go already.
Wouldn't it be nice if people would just stop this not invented here syndrome and work together to collaborate? It's incredible in this day and age when we say we really are globalized, but we still want to, it's a bit of that one-upmanship, isn't it? And it's such a shame. And I would wholeheartedly agree with what you're saying, Andrew. What I see, coming up for treasurers is, more reporting, more granularity. As it matures, things will develop further and further, but it will become almost impossible to do the day job if all the requirements are diverse. And that's why we don't want diversity, is in the requirements. So I would really endorse what you're saying there, Andrew.
As an organisation coming together with the American Institute of CPAs, people said to me at the time, why aren't you coming together with a UK-based body? And I said, well, if we come together with the Americans, we do something globally and we change things and we get good diversity of thinking. We don't change anything coming together with a UK body.
Makes sense.
But there are definitely also new signals coming from the US administration. I must say, Andrew, I do slightly disagree with you when it comes to the UK, but we could have this conversation of like there are lots of actually emerging countries which are making very good progress on regulation. They may have the best regulation in the world. I'm thinking of Brazil, for example, but then when it comes to enforcement of that regulation, it's a different matter. So we need to be wary of that as well. But I cannot agree with you more, Caroline, on the need for more coordination. And Andrew, the initiative that you mentioned, this new joint efforts by the GRI and the SASB are very much welcome. When I mentioned earlier in the panel the frustration of companies that we speak to, I was referring to the frustration in terms of reporting, because in addition to GRI and SASB, they have the TCFD, they have the CDP, and then the ESG vendors that ask them for lots of information. And now we are the investors asking the additional ones. So they're really, really struggling to cope with demand. I'm glad that the audience has started to ask some questions. And perhaps I can open now to the Q&A session. In fact, there is one question that I wanted to ask you anyway. Somebody is asking, creating an education agenda is often based on teaching known risks and methodology. How do you create an effective pathway given how much is still to be understood? Which probably resonates a bit with what Louise was saying earlier about the fact that we don't know many of these risks that we're trying to measure. Perhaps, do you want to take this question, Louise?
Yes, thank you, Carmen. Yes, there's a lot we don't understand, but there's quite a lot we do understand. So the education pathway, I think it was Andrew earlier who was talking about we can't think of education just in terms of the core exams. I mean, we in the IFOA have, I think of our 33,000 members, 15,000, over 15,000 have finished their exams, and in many cases, I speak personally here, finished them some years ago. So just changing the exams isn't enough. So we have to provide resources for everybody, both those people starting out on their careers and those people who need to upskill during their careers. So I very much say we focus on what we do know, but we also, people have to know what they don't know. So it's education in the terms of helping people learn how to think about these things rather than necessarily just stuffing them full of knowledge that will just sit there. So it's educating people about the issues and about how they can find the resources to keep abreast of things.
That's so sensible, isn't it? Because otherwise, particularly something moving so fast, how do you keep everything up to date? It's just an impossible task. It's like I remember years back somebody saying to me, when you go to university, it's not to learn a subject, it's to learn how to learn.
Definitely. And also when it comes to mapping the materiality of these factors, it's not a static mapping because it changes over time and the relevance of these factors change over time. And what you said earlier, Louise, about thinking in terms of probabilities is very topical because and necessary, I would say, because it helps all the actors to be prepared to different scenarios. And if anything, the COVID experience which has taken all of us by surprise, has shown that the corporates that were better prepared and had better risk management in place have reacted better than others. There is another question which is slightly provocative, and I'm going to pose it to all of you. How do we generally move away from shareholder returns being prioritized? Surely government action, and ideally globally aligned, as Andrew was saying earlier, to create a system of either penalties or rewards for polluting and improving the environmental situation is not the only way going forward. What do you think, Andrew? This is for you, definitely.
I'm surprised that the market is actually producing its own solutions to this. If you take a look at Kraft trying to buy Unilever a few years ago, Kraft, the ultimate shareholder value type of thing, they would have extracted maximum shareholder value from Unilever. That takeover bid was fought off. Look at the share prices of the two organisations now. Unilever is probably worth 4 times as much as it would have been had it been subsumed into Kraft, and that is an example of a business which is setting out as its objectives to meet the needs of multiple stakeholders. It's reporting to them, it's saying it's accountable to them, and we're seeing in real life that happens. I'm not going to say that will always happen. There is a natural business cycle. Companies are born, companies die. That's capitalism. But if you're going to be successful, we're starting to see that those who look at multiple stakeholders are automatically thinking long term. They're creating that long-term value, and that's starting to be reflected in their share price and seen by the market.
I would absolutely agree on that one. As Unilever, my old employer, even back in the day when we were really starting to look at sustainable issues ahead of many others, and people would accuse Unilever of being a bit slow and cumbersome, and it was a very large organisation, and the way we worked was very much on a consensual basis, so there's a lot of discussion and so on. And some people felt it maybe wasn't as fast paced as some of its competitors, but I think what they did was set out a vision, and then that was built on by the next chief executive and so on, and really tried to do what was right. And I think it's very interesting, this question, because on the one hand, I do think sometimes targets and penalties can help to shift people. But on the other hand, what I've always believed is when people go around kind of policing things, they always find a way around things. And then you get into discussions like greenwashing and all the rest of it. Whereas if you have real leadership and you get people to follow you because what you're doing is right, then it's much more powerful and it's much more sustainable, in fact. So I'm a little bit probably on the fence on this one, because I can see that sometimes you just need to take some action when people are behaving badly. On the other hand, the more sustainable approach is that persuasion. It's getting people on board. It's getting people to put pressure in a different way than merely governments giving penalties.
Yeah.
For me, regulation just creates a floor beneath which a standard can't fall. It doesn't drive great practice, though.
I think what Caroline said is really important. So it's commonly said, or it has been said in the insurance world, that a 4-degree world is uninsurable, and that's reasonably broadly accepted. So insurers need to think about the effects they're having, the impacts they're having. If they are trying to maximize their short-term profit in order to maximize their, short-term return on shareholder value, are they doing things which is going to mean that they will not exist in 20, 30, 40 years' time?
Absolutely.
So you can't, I don't think you can see shareholder value as isolated from anything else, because shareholder value depends on, well, there still being a world in which there are shareholders for a start. But, again, it gets back to this systems thinking, that you can't just isolate one component. You can't just aim for a single target and expect everything else to go right too.
Yeah, and I think, as Andrew said, we need regulation, but we don't need regulation to be overly prescriptive, because it risks putting a cast around the whole system and kill innovation in the end. So it's a matter of balance, I would say. I'd like to take one final question before we draw to a close. So somebody's asking, does the scale and scope of ESG mean we have to look at integrating the approach of treasurers, accountants and actuaries, insurers and bankers, and learning more from each other? Well, I think today we have a great example, because we already have the three of you representing these three different categories working together, which is wonderful. Perhaps, Caroline, do you want to address this first?
As I said before, we are global citizens, I believe strongly, and we just have to collaborate and cooperate. You learn so much from others if you do work together. I'm not sure how this will happen, but I would certainly from my side be open to working with others and trying to, one, learn, but two, provide consistency, so that it's not as painful as it could be for all of those that you mentioned in the question.
Great. Andrew and Louise, do you want to add anything?
I think collaboration is really important. Different groups of people have different skills, different expertise, different outlooks, and they're all important. And just sort of going down one narrow track, one way of looking at a big problem is unlikely to lead to success.
I think that collaboration, the collaboration is already happening. It's many years since people like PwC describe themselves as chartered accountants. They employ way more than accountants now. They will employ treasurers, they'll employ actuaries, they'll employ all kinds of other professionals to bring together multidisciplinary teams to solve problems. And that's the way the world is going. We don't go forward in isolation. We go forward together.
Absolutely, and I would add that it's very much about not only knowledge sharing, but also resource sharing, because each of you are doing quite a great deal of work, but sometimes it's not very well communicated across the different stakeholders. So that communication and engagement is key, really, not to reinvent the wheel and create synergies. Very important. I'm afraid it's time to draw to a close, and time always flies particularly when debates are very interesting. So I would like to wrap up this final session of the anniversary celebrating the Green Finance Education Charter. And I would like to ask each panelist to share one final thought very quickly, like a 1-minute thought. Perhaps we can start from Louise, and then we'll go to Andrew and then Caroline.
We mustn't forget adaptation. Mitigation is really important, but climate change is happening, is creating problems for us now. We have to work on our adaptation and managing the risks of adaptation, as well as trying to mitigate climate change.
Thank you.
I would say businesses need to integrate their thinking, think about all the capital they use, all of their stakeholders, and focus on that focus on long-term success.
I would agree with
Great.
both of those, and maybe just add, in the spirit of collaboration, really get to understand your supply chains. Those are people also that you can be working with and learning from.
Excellent. So adapt, integrate, and understand supply chains are the three main key takeaways of today's session. I would like to thank the audience for being with us today. Please join me in thanking Caroline Stockman, Louise Pryor, and Andrew Harding for their contributions to today's panel. And thank you for bearing with us throughout these 3 days. And I wish you all a very good day. Thank you and goodbye.
Thank you, Carmen.
Thank you.
Everybody, thank you.
Thank you.
Thanks all.